So today let's take some time to talk about VTBs because I'm seeing a lot of sellers are offering VTBs to incentivize buyers to transact and to close, but a lot of investors do not fully understand VTBs and how VTBs can play into the financing part of the deal. So today let's take a few minutes to clearly understand VTBs. So what is a VTB? A VTB is nothing but a private mortgage. It has a very enticing name called a vendor take-back mortgage or seller financing, but whatever name you chose to use, they all mean the same thing. That is, the seller now is going to be your lender, providing you with a mortgage. Sometimes VTBs are first position mortgages and sometimes they are second position mortgages. Now, all real estate investments will follow the same principle. That is, you have to find a deal first and then finance it. And then you fix up the problems or add some value to the property, and then you exit in the form of selling the property or refinancing the property. So if the acquisition financing is going to come from the vendor, so your acquisition financing, it's pretty much all sorted out. That is why a lot of sellers are offering VTB currently, because they want to make life easier for the buyers and therefore pushing the transaction to the finish line. But since VTBs are private mortgages, they can be designed very creatively and structured very creatively too. No two VTBs are the same. But since we're demystifying VTBs today, let's go through a few common scenarios and see how these VTBs can impact your acquisition financing and, more importantly, the exit financing. On residential mortgages, when VTBs are in first position, rarely will any institutions go behind a VTB. Some private individuals might be willing to go behind a VTB, but it's not very common. So some VTBs are going to be in second position after a bank, so you will still have to source a first position mortgage from a bank first. But usually, these mortgages from the banks will have covenants in place saying that they will not allow any secondary financing. So if you do intend to get a first position mortgage from a bank and later on put the VTB behind it, be aware you can actually breach the contract and you can actually get into trouble with the bank lender. On commercial mortgages, VTB are more common, so if the VTB is going to be in first position, then great. As long as you can come up with the down payment to complete the capital stack, then the deal can now go forward. And unlike residential lending, in the commercial lending space, institutions are more open to VTB being in second position, but usually they will factor in the payments that you need to make to service the VTB as expense, so that's going to reduce the net operating income. But if the net operating income after paying the VTB payments can still service the mortgage from the bank, they will actually allow VTB to be part of the capital stack. Now earlier I made it very clear that VTBs are private mortgages, so they're usually shorter term. So how are you going to be able to pay off the VTB can be very important, because if the seller, not the lender, refuse to renew the mortgage at the end of the term, you will have to pay it off either in cash or find another loan or to sell the property to pay off the VTB. Otherwise, you can be in trouble with the lender and you can get litigated and enforced, and that's the situation you probably want to avoid. So it's very important to understand what kind of loan you're getting into, and more importantly, what your business plan is, how feasible your business plan is to eventually pay off the VTB and get into a cheaper and long-term product. So if you're looking for assistance to help you complete the capital stack, optimizing the structure, and understand the feasibility of obtaining acquisition financing and all the way to takeout financing, I'd be more than happy to help. Please go to my website, KaiLu.ca, where you can book an appointment, and I look forward to helping you.